guys? Alright, for today's video, I want to kind of combine some of the things that you guys, have had questions on, or some things that I think are really, really important when it comes to being self-sufficient, when it comes to really being able to trade well. And the first couple of things, might seem like pretty minute details, but they actually come into play a lot when it comes to being profitable and then making the most out of our gains or cutting our losses before they get too big, right? So the first thing I want to go over is just how I assess strike price, how I know what contracts I'm going to play when it comes to playing my watch list. So I'm going to use DKNG in this example because it is going to be on my Monday watch list. It's been getting some good momentum here, building up finally, maybe starting that bottom, right? So that's something I'm looking into as well. But first place I'm going to start always is with the flow. I want to see where are people hitting these contracts, where's the good volume that gives us enough liquidity to get in and out of these contracts, and then pair that with the TA side in order to really select what contract I'm going to play. So when I first look at this DKNG flow, right, the first thing that sticks out are these 114.30 calls. These 121.30 calls have been getting hit real good for since about Wednesday, I think was when I first noticed that, first put that on the watch list, right, was these 30 calls, and they're continuously getting hit over and over, rolling into these 121.30s. And then we also see 114.27, cool, 17, those are last week, 121.45 calls, awesome. That's really, really high, really, really out of the money, which I don't expect to move that high. That may be, just some lotto type move, but we'll keep that in mind. But I also like these puts here, 114, 25 put, 26 put, getting hit on the 17s, cool. So next thing I'm going to do is go over to DKNG, use its actual chart, these levels, to combine this with that flow to get a strike price. So one thing, that's a rule for me personally is we don't want to play something too far out of the money when we're playing weeklies, right? So an example of this would be, those 30 calls there are getting hit, but they're about almost $3 out of the money from our call trigger in this case. So I don't want that too far out of the money because that can diminish our returns, and theta and time also come into play since we only have a week for it to hit the 30. On the downside, those 25s, there's some pretty decent support here around 26.35 to 25.75 that shows, maybe those 25s are a little bit too far out of the money as well. So what I want to keep in mind, is Monday, Tuesday, Wednesday, we can get away with the 1 to 2 out of the money weekly expirations, right? But when we get to that Thursday, that Friday, I'm going to look more towards right around the money or 1 out of the money. Why? Simply because that theta decay, that time. If you're struggling with the IV, those quick up and down moves, the theta decay, I would suggest using a week out, maybe next week's expirations when trading the Thursday, Fridays. This gives us a little bit more time on our side, and we have a little bit more room for error when it comes to that risk we have associated with the time and the theta decay. All right, now we're going to look at these levels. So when looking at these levels, I've set this call trigger up here at 27.8. I'm going to use the hourly to break this down a little. So on the hourly, right, we see this 27.8 has acted as support here a lot. And then on the 15, again, we hit that level again before ultimately falling off. So I like that call trigger. It's also about that 22 to 25% area of the daily range that I look for when using that 20-25% method. On the downside, 26.75, I like underneath that. We've been hitting this a lot, multiple times. We get to close under that. Plus, we have this VPA gap here down to about 26.35. That's a good move. So I'm going to couple that, this simple little TA key levels plus that flow in order to play my watch list. If we get over this 27.8, I like the 28 call over that level. Simply because, we have this big resistance here at this 28.05. Over that 28.35, and we got a couple more resistances before we really get to that 30 level. So that's going to help us to lock in more profits than say a 30 call would. On the downside, I like 27 puts, or 26 puts, not 27 puts, nope, 26 puts, because we do have good support here around this 25.75. Under 25.75, we do have a quick drop down to that 25, 24 level. But I'm going to use that 26 level, 26 put more in order to reduce the risk and hopefully boost the amount of gains we can possibly see here. So I like those two. And that's kind of how I go about, just using our key levels, using the flow, what's getting hit, what's getting this volume right, but also coupling that with our levels to make sure it's not too far out of the money and it's a reasonable move. We don't want to go too far out of the money because, of course, that OTM and the theta decay comes into play. The last thing we want to think about when incorporating all of this is just the stock's personality. As we can see here on the daily with DK and G, it does have these big days where it goes, $3, maybe $4, but most of the time it's stuck in that 2.5 range on the daily. So even if we have a completely bullish day where it opens above and retests this 27.8 level, even a $2 move, $2.50 move is barely touching that $30 level, and that doesn't account for the downside that comes into play when sellers do get into control. So we're going to take that into account, and it really helps us to kind of focus in on those strikes we want to play, not getting too far out of the money. Another key thing that I want to talk about in this video is bid-ask spreads. In a way that I really use bid-ask spreads to narrow down my watch list is, there could be tickers running or tickers in the same sector, but the bid-ask spreads are pretty bad, so it's harder to get in and out of position and really fill where we want or need to be filled, right? So in this case, I'm going to use PayPal and SQ. They're competitors in the same field. I was asked a question about this the other day because SQ did have some big OTM hits, but I like PayPal simply because of the bid-ask spreads. In this case, we look at these. This is a closing bid-ask spread, so it's going to be a little bit further than how we run intraday. But these bid-ask spreads, they're about 0.2 to 0.5, 0.9 here on this 114, 195, call it close, which is cool. But I like to stick to that, 2 to 5% range on our bid-ask spreads so that I can get filled better as opposed to, a bad fill and then I'm down 10% already. And for me, that's a stop loss hit right when I enter a play. That's just giving money away. So with PayPal, we see these spreads are pretty decent, pretty close together, and we can play with that. But when we look at SQ usually has a little bit less volume as well, which comes into play with bid-ask. If this will ever load. When we look at SQ, right? Geez. All right. So we look at SQ. This 155 call does have a very good bid-ask spread, but look at this put. That's a 25-cent bid-ask spread. This is almost $1 just on calls, right? This is almost $1 as well. So if I get filled, if I trade the breakout and I get filled high, I could be down a lot to start. And then on the pullback, if I don't sell right, we're losing decent money on this. Probably going to get stopped out. So that's something when looking at tickers, I really, really like in choosing one ticker over the other. Another example would be NEO and XPEV. NEO has really, really tight bid-ask spreads. XPEV pretty loose, so it's a little bit harder to play. So I play NEO a lot. Next part of the video, I'm going to go over, execution piece and trading price action, right? So when looking, at trading price action is the biggest determining factor in a trade, right? So that's what we want to trade. That's why I don't really believe too much in indicators or use too many indicators, is because I want to trade what's in front of me, and that's price action. So on the day of the trade, after I've broken down my key levels, my trigger spots, I'm going to stay on the 5 minute exclusively. So on Friday, my call trigger on DKNG was 26.35. Put trigger was 25.75. So if we look at this, right, DKNG gapped up right away. So I don't trade in the first 15-30 minutes. So I know here that I'm not going to take this trade. If you do trade in those minutes, you could get this trade here and get a good rip up to that 28 level even. But I'm going to wait on a retest of my call trigger. So when it comes to this, we get these retests here, multiple retests. It does close below a couple times down in here, but we get we get above it, and then we get some closes, and then finally we get this here. So this is where an optimal entry point would be this big bullish candle here off of the 26.35 trigger level, and then we get a lot of consolidation, ticking in and out, in and out, in and out. But it has always held this 26.7, 26.75 level on the 5 minute. So you could scale here, stay in my certain case, right? I was able to scale out a little bit here on this kind of shooting star, and I kind of just let this play out. It was stuck in this range, didn't know which way it was going to take, but then I know this 26.75 was a big level, so I marked this down intraday, and we see this candle here, a hammer candle closing over 26.75, and volume starts to get going into power hour. So I'm able to enter in here again and trade this price action and really get some good gains here on a 27 call into power hour, just based off this price action, just based off this execution. For me, and for any account, risk management is a big thing I preach. And the reason for that is because it's a really, really quick way to blow up an account, not managing our risk. So for me, I set my stop loss always 10% hard when I enter in. You don't have to necessarily use a hard stop, but I found that for me, it helps simplify my trades and really, really focus on making the most of each trade. So once I've entered here, I have my 10% stop. Doesn't hit. This is actually pretty well placed trade here. Trade it pretty well. But once I'm up above, that 10%, that 20% is my first scaling area. For me, I always scale in thirds. So I'm going to scale out that first third at 20%. When I get out of that, I'm going to move my stop loss up to 10%, 10% profitable. So I know that I'm taking gains no matter what. My second scaling target is going to be that next big level that I've noticed or been able to see in terms of scaling out. So for me, it was about 27.3, 27.25 area. Was able to scale my second there. From there, I'm going to move my stop loss up to 20%. And all I have left is 1/3 runners. So my runners, I'm just going to let go that 20% stop loss. If I get 100%, if even like a 50 to 75%, I'm going to take all my profits out there. Just because, these are going to add up. Even if I didn't get crazy size on a trade, I can lock in these profits. A good 50 to 75% trade is awesome. We're not always going to get these 100%. We're not always going to get the 20%. You might get stopped out at around 5 to 10%, but those 5 to 10% really, really add up. So setting that stop loss is huge. It's really key. But when it comes to scaling, right, that first one, always 20% for me. Why? Because every play I enter in, I want at least a 2-to-1 risk to reward ratio. If it's not 2-to-1, why enter it, right? I want to be rewarded or have the possibility to be rewarded more than I'm risking. And for me, that's 2-to-1. For you, it might be 3-to-1, stuff like that. But in the end, the base hits really, really add up, and they can help us compound over time. Greed is a really, 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 the emotions in the end are what are going to kill our accounts, right? This greed, looking for these things you see on Twitter, the 100% gainers. And these come more after we have the system built in and continually push up. So most of the time, if I ever get 100 50, even 75% gainer, it's usually only a third of my position off the runners. And another thing when it comes to scaling, right, is, once we get over that 20, 30%, I'm going to keep moving it up about 10% down. So if I'm at 30%, put my stop loss at 20%. 40%, 30%, continually go down, whatever. But if I reach that 100%, I might always be scaled out. If there's a ton of volume coming in, down here as we can see, there's pretty good volume coming in, and it's pushing higher through these levels with ease, and buyers are building up the dips, I have no real reason to get out. So I'm just going to adjust that stop loss up about 10% trailing stop, and just let it ride. Let these winners win. That's another big thing. Letting the winners win and cutting the losers early. This will help us build our account, especially these smaller accounts that I focus really heavily on, because we don't have that much capital to just throw around, right? So that's something really, really important, really cool to see, and something that can really, really help when it comes to being profitable with our trades. When it comes to trading price action, I think it's really, really important to use this over indicators, right? Facebook's an example here. Facebook, did some chops intraday. There's definitely ways to make money over certain levels, under certain levels, all that. But all of our indicators are going to be a little bit of a laggard behind actual price action. So price action is real time. We can see it, and we can use the types of candles to really, really hone in on trading this price action, trading the way that the stock moves in order to make money. So when it comes to entering into puts, just based off price action, no key levels really, except for intraday levels that I've marked out here and there. These upper wicks show that sellers are coming in. So when I see multiple points like this, that this level can't break and hold or close above, it shows that puts are probably going to be more favorable, as the sellers have came in at these prices and defended them multiple times. So I'm not going to try and go against these sellers. I'm going to go with the sellers in order to play puts off of these higher wicks. And on the flip side, we have longer wicks near support around this 33.5 level, which was a put trigger on the day. So when I see buyers stepping in, it really shows me that they like the price at this level. So I'm not going to go against them either. Same as it would be for sellers on the opposite side playing puts. The longer the wick on the bottom, the more volume, the more of a confidence I can build up that this price is going to shoot up at some point. When it comes to learning price action and really, really getting in to understanding it, it's all about screen time. This is the number one way that I learned how to do stuff that I know how to do, and also how I think beginning traders can really learn is just looking at price action, understanding wicks, candle types. Big candle types I like to use are those shooting stars for puts and the hammer candles for calls, based off of key levels that I've identified when preparing for a trade, which can also be a very, very, very helpful way to become profitable, is making these watch lists and then trading off the watch list just to understand price action. Another thing is, I've talked about it a lot with small accounts in trading price action, but learning tickers inside and out and how they move, respect price levels, is something really big. For me lately, it's been PayPal. PayPal is one that has respected. These are levels I've had set for almost 2 weeks now. I've been able to trade off of every day for those last 2 weeks. Is just off of learning PayPal. Where does it bounce off of? Where does it get denied? And what are these key levels that we can really identify in order to take a trade either to the up or the downside? So when going along with that, identifying the overall trend, right, is we have trend flips in here and retest. So we know that puts are going to be more favorable when sellers are in control, and we have this downward sloping angle as well. So we take that into consideration. But over here, we had these days where PayPal was getting rips back up, and we were able to play calls easier when we notice, buyers are stepping into control as well. Another thing to go along with that, I don't really use indicators too much, but VPA is huge because we know price action is going to move slower in these levels, and we also know that they're probably going to pull back to these levels at some point to retest. So we know, once we get up to this 92, if we can close above 192.2 area, where I have this trigger, to this 192.45 area, if we can close above that, we have a pretty good chance of testing 194 level before ultimately falling and retesting others, as support and resistance come into a huge effect when playing price action, learning price action. Support turns resistance, resistance turns support. This is all based off psychology of people who didn't want it at one point, but were able to close over this. You have to cover a position if you're short for the bigger accounts and stuff like that. So we can really use other people's psyche in order to be more confident in our trades, as well as these key levels, and really learning price action. Price action will always be that number one determining factor in being profitable and really being a good trader, is really understanding and delving into price action. So my biggest thing there would just be find 2 to 3 tickers that you can really understand their price action and really get to know this price action. Then we can apply that to any ticker, right? And as always stated, I always say, screen time is going to be the biggest way to learn, and it's the most beneficial way to learn, is doing it while the trades are happening. Even if you don't have money in a trade or you're out of buying power, we can really just take notes, break down the trade while we're doing the trade, or where we would enter, in order to really learn price action of a ticker. And once we learn those 2 to 3 tickers, we can apply this to any ticker there is out on the market, and it can really help when it comes to being a profitable trader, becoming self-sufficient, and building the system that I preach so heavily on every day when it comes to being profitable, which is all of our end goals.